Greg Andrick here, bringing you another Business Freedom Conversation post. So, consumers have been holding up the economy for the last year or so, but has the canary fallen off its perch in the coal mine? American consumers are not spending like they used to. Here's a story from Yahoo Finance that came out today. So I'm going to show you the various elements of it and what you need to pay attention and see how it affects your business. Then more importantly, I've got about a little less than 3-minute video, again from Yahoo Finance, where an economist is being interviewed and kind of shaping up the winners and losers in the economy. Now, President Biden just came out with Bidenomics, and his basic Bidenomics is around the government controlling things, the government investing in businesses like, green energy, etc., all on trillions of dollars of borrowed money, which kind of squeezes out the regular business person. And, I don't know that any government-controlled country has ever really succeeded very well. It requires freedom for that people to work, 18-hour days to get the business off the ground and that kind of thing. So anyhow, I'm going to show you the elements of what's happening, because at the beginning of 2023, Americans had 5.5 trillion in savings, up from only 1.5 trillion in savings before the pandemic started. In other words, the end of the fourth quarter of 19, they had 1.5 trillion. Well, here in end of June of 2023, they're down to 3.3 trillion, and they're acting differently. But more important, the top end is acting differently. So take a look at the elements, and then behind all this, I have this 3-minute video from Yahoo Finance I think you'll find really interesting, because it shows where we're all fitting into all this. Take a look. So Americans are not spending like they used to. The American consumer is stumbling after months of surprising resilience. They've been holding up the economy. Spending has remained elevated even through the Fed's 10 straight rate hikes. Pretty amazing. Probably frustrated the Fed, probably also the reason the Fed had an unprecedented 5-point raise in the Fed rate in 1 year. Warning signs of change have started to surface. Look at the luxury watch market. Demand has fallen off the cliff. In other words, the sale of these items has gone way down volume-wise, and secondary markets have plunged to 2-year lows. This is all done in a survey by Bloomberg. Luxury watches, the price, are down as much as 35% last year. Even when the wealthiest spenders, start to taper purchases, it's usually not a good sign for the broader economy. Inflation in the U.S. has cooled from a historic 9% last year to about 4% in May. Now, I don't know very many people whose personal experience ties to this. And my concern is, as we dig into these more things, the control of the press, the control of all these agencies, that these numbers may not be true. But that's what the government says. And it took a dramatic increase in borrowing costs to get there. I mean, unprecedented how large and how fast. The Fed's goal is to hit 2% inflation. Jerome Powell said yesterday that he doesn't expect to get there till 2025. Remember, for the Fed rate to have an impact on inflation, it has to be above the inflation rate. Well, if inflation truly is 4%, then this 5% rate will help that, and we're finally going to see a change in the economy, which means pain to all of us. People are going to get laid off. Your business is not going to sell as much. And we're in this very strange situation of prices increasing, and maybe this will help hold it down. But remember, the last time we were in this situation, a stagflation situation, took 9 years to get out of. Bank of America CEO Brian Moynihan said his firm's data shows consumers have pulled back spending. Boy, if there's anybody that sees what's going on in our economy, it's Bank of America, and it sees what happens through all of their financial instruments like checking accounts, etc., credit cards, whatnot. So we may be on the precipice, and we're in a very difficult and interesting situation because there are so many indicators going in so many directions. But I want to also remind you that we've had two quarters, the fourth quarter of 22 and the first quarter of 23, where the economic output has gone down, but the only reason they're not calling it a recession is because the hiring has gone up. But that isn't generation of new jobs. That is the recovery of jobs that were removed from due to the pandemic. Anyhow, take a look at this 3-minute video from Yahoo Finance, kind of about where we are, and again, they're reiterating that it's going to take a long time, and that the long-term environment will probably be the volatility we're dealing with now and the higher interest rates. Take a look, see how it affects your business, and act accordingly.
Had the highest CPI print in 13 years. It looks like inflation is sort of back. The market is changing. Legendary trader Paul Tudor Jones just said it's making him feel like he's in his 20s again, all this volatility. How do you feel about this market, and do you feel like you're in your 20s again?
Well, I want to take whatever he's taking to feel like he's in his 20s again. There's more volatility, but again, compared to historical, when Paul was in his 20s and I was in my 20s, I mean, it's kind of nothing. Back then, the 30-year bond, which is what we used to look at, would trade in a 30 basis point band in a day. Now it moves 3 basis points and people get terrified.
It's crazy because there are so many young Wall Streeters who have never seen a market like this. They've never been chained to their chairs. They've never been, glued to their screens in the way they have to when the market is volatile. Do you have any advice for those kids?
Well, back in my day, I mean, no one wants to hear that. What Wall Street has benefited from, among many things, is basically a probably once-in-a-lifetime move in rates from 14% to basically 2%, or zero, depending on your whether you're looking at short-term rates. And we're not going to repeat that. That's not going to. That I'm pretty safe in saying. So what Wall Street hasn't seen, with the exception of a few graybeards like Paul and myself, is high interest rates or rising interest rates for any sustainable period of time. And the big change will come when that changes. So I don't know if that's what's happening now. We'll see. But when you see things like Greece borrowing at rates lower than the U.S. for 2-year notes,
it's a little wonky.
It's a little crazy. And so things are happening in the credit markets that are making people a little uncomfortable. We've moved to almost 3% on the 10-year. But based on where nominal growth is right now, I mean, with or without a rising CPI, I mean, the 10-year should be north of 4%. So we're still in a very accommodative environment.
But we seem to have like a stew going here. We have this tax cut. We have this massive budget agreement between the Democrats and the Republicans that's going to add to the deficit. And it seems like corporations are really winning out. And it seems like labor, regular people like me, are kind of losing in this equation. This has been going on for years. How do you stop it?
Yeah, the rent-seeking economy.
The rent-seeking economy.
It really is a puzzle. And I was reading a column in the New York Times this morning talking about that and why we haven't seen more competitive forces bringing returns down to where rates are. I mean, that's in a highly competitive economy. If interest rates are so low, returns should be dropping. Instead, returns on corporate assets are remaining high. And some of that might be technology. Some of it might be just simple lobbying, rent-seeking. And I think it's probably a combination of both. But what it does lead to is stagnating wages, lower capital investment, and a disproportionate amount of the economy going to the corporate sector and shareholders. And that's great for equity holders. It's not really great for everybody else.